Hello and welcome back to Katie's Business Tips. Michael Lapede here, going to talk to you on a small series about tax planning for business owners. And in this first video, we're going to talk a bit about structuring. We've talked a lot about structuring, so we're going to do a quick synopsis. You can go back to our structuring videos, of course. But as discussed in prior videos, there are various structures you can use for your business. Of course, sole proprietors, corporations, partnerships, limited partnerships, cooperatives, and all these lists goes on of different types of structures that people use for businesses, including trust arrangements for business. Now, most people will use corporations for their business. Let's be honest though, you will use corporations. And when you're using corporations, you want to make sure that you structure with a professional. If you are going to save tax, you're going to have to be structured well to save the maximum amount of tax. If you're not structured in the most tax efficient way, you will pay extra tax unneedingly. So consulting with the professional, asking questions, making sure you have the best structure up front and what that also may look like in the future as your business grows. Very important for tax planning. Now, when we talk about corporations, we set up a corporation and people always ask, well, what's the difference between a corporation and a holding company? Well, holding company is a corporation. It's just a corporation designated for use as a holding company. You can designate any corporation as a holding company, a capital corporation to hold capital and invest. You can designate it as a regular operating company to operate. It's all the same type of corporation. It's just how you designate what you're using for and you put on the tax return, this is what we're using it for. Simple as that, okay? Now, when we're using holding companies, we also look at using trusts, obviously, and the concepts we've been talking about the trusts in the last few videos you can go back to, but we use combinations of trusts and holding companies that typically own the operating company in certain methods and manners to make sure that you're getting the most tax efficient finance available to you. Funds flowing in, funds flowing out, loans, dividends, income, all these different factors come into the tax plan when we're looking at your structure. And that's past and present and future we're looking at together. Now, the following factors will help you determine what structure you're going to use. Here's some key points. Number one is your projected gross income and net income. How much money will be going through the company and how much income will you be taxed on your net taxable income at the end. The next thing is what kind of capital will need to be raised. Are you looking to raise capital? Will you need to raise capital? Maybe you need to raise capital, and is that a question, right? Do I need capital at some point? Because your structuring will affect you raising capital. How many partners or investors or shareholders will be involved in the company? That's a key factor again in the structuring. For one example, let's say you have an operating company and you go, hey, I want to issue another corporation all the dividends and get the money out of this operating company with the liabilities, move it to a holding company. Well, that's great. And you can say, hey, the holding company is going to own a part of that company or a piece of it. That's fine if you're the only owner. But as soon as you have a partner or more partners, you then have to have your ownings of the operating company in a holding company due to Section 55(2). And what that now does is allows you to have dividends to that holding company, just as if you would when you're personal and own just a piece of it. But now you have to have all your ownership in a holding company because you have a partner. That's why you need to know up front, will I potentially have partners? That's important in your structuring. Investors, will you bring investors in? What does that look like? And so forth. Another one is, will the business be your main source of income? Or will it be an income supplement? That's also another factor in your structuring. Do you want to have continuity if something happens to you? If you're a sole proprietor, there's no continuity. You are the sole proprietor, you're done and the company's done. Whereas a corporation or trust or partnership, maybe, typically corporations and trusts can carry on, right? You can sell the shares of a corporation and the corporation can carry on. And the last one here is, what potential risk are you taking? How much do you need from a liability point of view? Because sometimes, even if there's not as much tax savings in a structure, but you see that there's liability potential, you might want to structure just based on that liability to protect yourself, right? Determining the best structure for your business is really key to your successful tax planning. That is one of the keys at the beginning. And we always want to remember, the final tip I'll give you here is, remember, when we're structuring, we want to look at including family members. Right? If you're married or you've got kids or siblings maybe, and parents or older elderly parents, all these things, we want to consider those family members in the structuring. And again, talk to a professional, talk to someone who knows about structuring, plan it out. The sooner you plan your structuring, the sooner you structure yourself, the better off you are for tax savings. Look forward to hearing from you. Hopefully post in the comments below and we'll see you in the next video.